Hey Ruth, how's it going? I think you're muted right now.
Sorry about that.
No worries. How's it going? Welcome back.
Thank you. I'm excited to be back. Let me just check out sharing my screen.
Oh yeah, let me give you those permissions again really quick. Awesome, you're all set.
All right, let's just check it out real quick. Can you see it?
I
Yes.
can see it. I can see a lovely cobra back there.
Yeah, that's my thing about how people react to financial statements
Oh,
as a general rule. All right, I will unshare it until we're ready to do it. So,
awesome. Sounds good. How's
yeah,
your week been?
good. How was your week? How is San Francisco?
All right, all right. I'm actually in the Bay Area, um, in the South Bay, but
Okay,
it's not too bad. It's starting to warm up here, you know.
come
Uh,
to Atlanta.
what's that?
Come to Atlanta. It'll be hot.
I bet it's ice cold there.
Yeah.
We were just talking about the East Coast and how it's probably, I mean, I've only been there to visit a couple times, so I don't really know the experience, but man, I bet it's like hot, humid, you know. We complain over here in California, but
No, no, no,
I don't think
no.
we should be allowed to. It's pretty nice over here.
We jokingly say there's three seasons in Atlanta: spring, fall, and August.
In August. Oh man. How hot does it get over there?
There have been some summers when it's been almost 100 degrees with like 60, 80% humidity. It's hard. You go from your air-conditioned house to your air-conditioned car to your air-conditioned office and back. You
Yep,
don't go
yep.
outside in the middle of the day. It's just too hot.
Yeah, it's like hopping across lava.
Yeah.
I noticed the background's different. You're in a different spot today?
Yeah, I'm home.
Oh, nice, nice,
Yeah,
nice.
I'm not in the office. I had a meeting with a client today, and then there was no sense in coming, going back to the office and waiting at the office for 4 hours. So I just decided that I would do it from home tonight rather than the office. So you can see a nice background, which, do you know what that is?
I do not. Is that a specific place?
Yeah,
I don't know. What is that?
it's Coliseum Falls.
Coliseum Falls.
It is a trail in the White Mountains of New Hampshire. And
Okay.
I hiked the falls, and this is one of the waterfalls right, along the path.
Wait, what was it called again?
Coliseum Falls.
Coliseum Falls. So that's a picture that you took?
Mhm.
Oh, nice. Nice, nice. I was thinking that was a place over where you are, actually.
No, this is actually I have a client in Maine,
Hmm.
and so I had to see him like the Tuesday and Wednesday after Memorial Day, and so I took the Friday before and went hiking up in the mountains for a couple of days. I mean, I flew into I think it's Portland we fly into. Maine, not Portland near you.
Mm-mm-mm.
And
Yeah.
then I just drove over there. I mean, it's like, it was an hour and a half drive, no big deal. Found a
Yeah.
B&B, found a bed and breakfast, and it was just a cool little weekend.
That is awesome. That is awesome. I feel like I just haven't been around the US enough, you know? I think one of my first and only trips was, well, not first, but one of my only trips has been actually with Skillcat going to TAA in Texas to a
Hmm.
conference in Texas. And man, just being in, I mean, it's still the US, but like, just being in
Different.
being in a different state is surprisingly different.
It's
Yes.
very different. Yeah,
Yeah.
Texas is very different from the Bay Area. I can guarantee you
Oh yeah.
that. Where in Texas were you?
San Antonio.
Oh, that's different than Dallas, which is different than Houston, which is different than Austin, which is different than Amarillo. I mean, every area in Texas is
Yeah.
really kind of different.
Yeah, I hear every city in Texas has its own. I mean, I haven't been to the other ones, right? I've only been to
Yeah.
San Antonio, but I do hear that they're so different that, everyone has their own favorite, you know? It's
Yeah.
like, oh, I'm either a Houston person, I'm either a Dallas person or a San Antonio person, you know?
Yeah, it's absolutely um this is how Dallas reminds me. Dallas and Fort Worth. Well, not Fort Worth. Fort Worth very much of a cowboy rodeo town, and then
Hmm.
Dallas is the big skyscrapers. And I describe Dallas as skyscraper number one, done by millionaire number one or billionaire number one. Millionaire billionaire number two says, I want a skyscraper with my name on it, but it can't look anything like skyscraper number one. And if you look at the Dallas skyline, it is so eclectic because nothing is consistent. New York skyline is pretty consistent.
Hmm.
You look at it, it's all big square buildings for all intents and purposes, with very few exceptions. Chrysler Building, Empire State Building, stuff like that. But it's just long, big columns. Not Dallas. Dallas is kind of, it's like it's very eclectic skyline.
Yeah, yeah, huh. That is very cool. I gotta look up some pictures of Dallas now.
Yeah, go look at some pictures of Dallas. You'll see what I'm talking about.
Dallas skyline.
You see it?
Okay, yeah, I see. Yeah, yes. It is it is all over the place.
Yeah.
Oh man. So what would you say is your favorite city in Texas?
Actually, I prefer hill country in Texas. That is my favorite area of Texas. So you go to Austin and then you go west about an hour.
Oh, okay.
And it's right in the hills before it starts getting, Texas has every climate. It has desert, it has, hills, not huge mountains like, you have in the Rockies, but um it's just a really gorgeous part of Texas. You get down near Midland, it's like desert. Amarillo is tumbleweeds,
Mm-hmm.
stuff like that. So it's actually a really cool part of Texas.
Interesting.
And
Yeah.
I like San Antonio too. San Antonio is one of my favorite cities.
Yeah, San Antonio was yeah, we went
Did you do Riverwalk?
yeah, we actually stayed. Our hotel was like right above the river walk. It was like sitting on it.
How was it? Cool.
Yeah, yeah. So I think we could, kind of
Roll out of bed and go down Riverwalk.
yeah, exactly. Just kind of go down, past the lobby and there's Riverwalk. We actually went. We apparently went during this like week-long festival or something like that. I think they just call it Fiesta,
Yeah,
and it was crazy. Every night there was a concert going on across the street, at the convention center that we were,
yeah,
where the conference was. Right next to us also, there right next to the hotel, there was another spot where there was another festival going on.
yeah.
There's apparently five more festivals going on down the street. One night we saw fireworks going off randomly, and it's just like, wow, like, oh, okay, this is San Antonio. Okay.
Yeah, San Antonio is not always like that.
Oh yeah, okay, okay.
No, not even close. But the Tex-Mex in San Antonio is really good.
We um we went to a place called Torchy's. I don't know if you know the name. Okay, but apparently that's like the best spot. We went there and it was pretty good. Um, but yeah, I was curious to know if you knew it. Apparently everybody knows it down there.
Well, I haven't been there in a few years, so it doesn't mean that. Let's see, which were the ones I used to like? Now you're making me think.
I only remember two places going there. I think it was a Torchy's and then an IHOP. But IHOP's everywhere, right? So
Yeah, the IHOPs are anywhere.
yeah.
I'm just trying to think. Um, I don't remember. Oh, well, we'll be doing this thing and I'll think of it and go, aha.
Yeah. Oh, by the way.
Now I wouldn't say that during it, I promise you.
It's yeah, it's interesting that you brought up hill country, right?
Yeah.
Yeah, it's interesting they brought that up because I've that's the first time I'm hearing of it. Usually people are like they have the feud between, uh Houston or Dallas or something like that. You know what I
Yeah,
mean?
Houston is my least favorite city in all of Dallas
Oh
or in
yeah.
all of Texas. I do
What
not like Houston at all. It's
what
hot
about it?
and more muggy than Atlanta, believe it or not,
Oh. Hmm.
and flatter.
Yeah, flat. Yeah. Yeah. Flat gets to you after a while,
Yeah,
for sure.
doesn't do well in running. I like hills to break it up.
Yeah. Yeah. Um, I went to visit a buddy in Idaho, and that was flat. That was so flat. So I know what you mean. It's
Where were you in Idaho that it was that flat?
yeah, maybe it was just the area.
You down by the Snake River?
We were near Eagle, just outside of Boise.
Yeah, Boise's pretty flat, but you go north and you're in the mountains.
Oh yeah, okay.
Yeah,
Maybe it was just the immediate area we were in.
yeah,
Um,
Boise's actually in a bowl, literally. I mean, if you think about like a cereal bowl or something like that,
you're like
that's
at the bottom.
there are Boise's at the bottom of the bowl, and then everything around it. Yeah, I mean, you go a half hour north, you're in the mountains, and you get snow upon snow upon snow, and
Um,
there.
mm-hmm. Yeah, I guess that just shows I never left their neighborhood. That's just must just been sitting in the house all week or something.
Yeah,
Um,
or you didn't explore, outside the city.
yeah, yeah.
So we got a minute.
Mm-hmm. Yeah, I think everything's, let me just double check. Oh yeah, you were able to share your screen
Yeah.
already. Co-host set up already. All right. Awesome, awesome.
So we got 18 seconds. So am I introducing me tonight?
Yes, yeah, I'll give
Okay.
a little quick, this is Ruth, and then you can take it from there.
Okay. Sounds cool. Doesn't look like very many people are online tonight either.
Yeah, it's a little bit yeah, maybe because of the busy season, everybody's kind of yeah, but probably have some more people trickle in as we go on.
Yeah, absolutely.
All right, awesome. I see we got two very lucky folks in the audience, so I'm gonna go ahead and let them in now.
Yep.
All
And we'll
right,
get started.
all right. Three actually. Hey everybody, hello, hello. How's everybody doing? All right. Well, I hope everybody's weeks have been well so far. We have Ruth coming back. You may have, if you tuned in last week, you would have seen her as well from her past webinar. But yeah, she's back today for another one, and I'll let her reintroduce herself and what she's talking about today. Take it away, Ruth.
Thanks, Elliot. Appreciate it. And thanks to all of you for joining us. Let me share my screen. And we will get started. Terrific. All right, last week when we got together, we did the bookkeeping side. Tonight, we're going to do the financial statement side. We can't do can't's not the right word. doing the financial statement fundamentals without accurate financial statements, which your bookkeeper supposedly produces every single month for you, doesn't do really, really well. We absolutely, bookkeeping comes first. You got to have accurate statements so that with what we covered tonight, you're going to be able to make better business decisions about what's going on with your business. So welcome to part 2. And obviously, thank you for joining me tonight. I appreciate you taking your times out of your very busy schedules and spending, about an hour with me tonight. And we'll go through everything tonight. Okay. Now, it's really interesting because most people, and I talk to a lot of people and have for the past 40 plus years, most people think, oh my gosh, P&Ls and balance sheets, yuck. They're hard. I don't understand them. I don't want to do them. Why do I absolutely have to do them? And they just think that they're hard. They approach them like a cobra. Blech! I don't like it. Stay away from me, everything else like that. And there's a lot of fear with respect to understanding P&Ls and balance sheets because they're afraid of them. They don't understand what they say necessarily. And as a general rule, you stay away from the snake, so to speak. So, I don't agree with that. And I really and truly do think that they're wrong. And we're going to go through some things tonight to hopefully change your mind about financials and give you a fresh approach and a new way of looking at them so that you can get comfortable with them and, believe it or not, excited about them after a period of time because it's your scorecard. How well did you do? Hopefully you did really, really, really well. Think about them as a nice little putty cat. Or a nice puppy dog or whatever else it is, whatever nice pet that you have around. So they're really actually pretty easy and simple to understand. So all of you, I assume, who are online tonight know that this is a wiring diagram. And the first time that you looked at a wiring diagram, you went, I know what this is, right? I mean, you've never seen one before. But the thing that happened with the wiring diagram is that you had to learn it because it was essential for your job. You couldn't do your job with figuring out how to wire boards, how to wire capacitors, how to wire motors, whatever else it is, but you needed to learn the wiring diagrams. And then, once you got what all the symbols were and what you got where all the lines went and the arrows went and everything else like that, you went, why did I ever think this is hard? Well, that's really the same thing that happens with financial statements. The first time you look at them, it looks like this wiring diagram and you go, I don't know what that is. But, take a look at what we're doing tonight, read, one of my books or, anything like that. And you're going to get it in English and you study a little bit, just like you did your wiring diagram. And it starts making more and more and more and more sense. And then all of a sudden you got it. Why did I ever think this was hard? Okay. All of us have learned to drive. I assume everybody on here tonight can drive, has a driver's license. We think about the first time we got in the car when we were 15 or 16 years old, the first thing that went through our mind was freedom. Yay, I'm not tied to my parents anymore. But the reality was the first time you got in the car, it was a little scary, a little nerve-wracking because you got to pay attention to so much. And then it became reflexive after a while. Again, why did I ever think this was hard? Now, the thing about driving is now that you've got it so it's basically reflexive and you're not paying total attention and you're texting, and what happens? You crash. So the same thing happens with financial statements. If you stop paying attention to them, your financial statements may be going, hey, you need to take care of this. And you're not paying attention and you will crash. You'll have a cash flow problem. People are not paying their bills. Your profitability is going down. Your costs are going up, da, 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 da. Pay attention. All right. You got to pay attention to the road. Pay attention to your financial statements too. Okay. All right. So tonight what we're going to do is we're going to learn why gross margins don't matter. Yes, gross margins don't matter, except for one case. A little bit about profit and loss statements, the basics there, the basics of pricing, and the basics of balance sheets, and then what you need to do every single month. That's what we're going to cover tonight. And if you don't mind, either put your questions in the chat or leave them until the end, and I have a big question mark, and we can answer questions at that point. Okay. All right. A little bit about me. I have been in this industry since 1987. I have worked and done presentations for and worked with contractors all over the country, with the exception of North Dakota. So I'm looking for a reason to go to North Dakota. So if any of you are online in North Dakota, let me know. These are the books that I've written. The last three are the ones that are really and truly about profit and loss and building wealth. Courage to be Profitable was the one I really mentioned a few minutes ago in terms of explaining what a P&L and balance sheet is in English. They're all on Amazon. They're all on Audible. I read every single one of them, and they're also electronic on Kindle. So you can read electronically or, book, or you can listen, and you'll get it. All right, so what's the most important thing you do every day? How do you actually generate revenue? And most of you are thinking, okay, I sell service, we do a replacement, we do a project, we have maintenance, whatever else it is. But that's not how you generate revenue. You generate revenue through billable hours. If your field labor is not out at Mrs. Jones producing a billable hour that you can bill Mrs. Jones for, you're not getting any revenue. So the most important thing that you want to do every single day is to maximize billable hours profitably. We're not a supplier, we're not a manufacturer, we're not a distributor, right? So our labor is the only way that we generate revenue. Well, we add the materials and the equipment and stuff like that, but you don't get the materials and the equipment unless you get the billable hour of labor. And you've got to maximize it because they have 8 hours today, it's gone. Another 8 hours starts tomorrow. If you only bill out 3 hours of that 8, you can't save the other 5 hours up for tomorrow. They are gone. Unlike the inventory that's sitting in your trucks or on your shelves in your warehouse, you don't use it today. Excuse me, you can use it tomorrow. That's not perishable. Labor is. And you put that on top of having to maximize your billable hours every day. We have to pay really, really close attention to how we bill our hours and are we getting enough billable hours every day? And I'll show you how to do that later as we go through pricing. All right, so I'm going to tell you right now why gross margins don't matter. This is a chart of 20 jobs from a new customer. Whenever I start working with a contractor, I go pull 20 jobs. I don't let them pull them because it's like, oh, I'm not going to show her that one. That one was bad. They think. Or that one was great. They think. But anyway, so we have the customer initials on the left, the selling price, GP is the gross profit, which is just simply selling price minus direct cost. Gross margin is gross profit divided by sales. Overhead per hour, OH, divided by hour, which means for every billable hour, how much overhead do you have to add? And I had already calculated this number, and I'm going to show you how to do it. Number of hours on the project, the net profit on the project, which is just simply the overhead per hour times the number of hours and subtract them from the gross profit. And then the net profit per hour is your net profit divided by the number of hours. All right, it's just basically your P&L, 20 jobs. All right, here are two. I've highlighted them. We have a 40.51% gross margin and a 40.27% gross margin. In my book, they're almost identical. Now, yes, they're slightly different, less than the 0.5% difference, 40% gross margin, basically. Look over to the right, and the one on top generated $73.83 an hour. And the one that's highlighted towards the bottom, customer won, because the company paid the customer $21.68 an hour. They lost $21.68 for every hour their guys were on that job. They lost their butt. All right, so that's why gross margins don't matter. And if you're paying your salespeople on gross margin, is that fair? They're both 40 for all intents and purposes. One, he should get a commission on. The other one, nobody won. Why should he or she? Look at these two. You have a 64.5% gross margin. If you look over on the right, it made basically $50 an hour. You thought, oh, we had a killing. Well, think about that. The 40% gross margin on top made $73.83 an hour, more than the 64.5. And then we have a 19.41% gross margin. You're going, oh my gosh, we lost our, and you actually made more. You made $52 an hour. So this is why gross margins don't matter. What matters is for every billable hour, how much drops to the bottom line. You need to know, if I have a billable hour, this is how much net profit I'm going to be generating. Percentages do not matter. I just proved it to you. All right. So you've got to really start and stop thinking divide by 1 minus the gross margin, and stop thinking everything about having a 20% gross margin, because it doesn't matter. I can show you 2 contractors. I did the example of it at ACCA last year when I did a presentation of the 20% myth. One of the jobs earned $50 net profit per hour. They both had a 20% net. The other earned 100. Which would you rather have, the 50 or the 100? Both had 20% nets. Different labor amounts on that job. That's what did it. All right. So that's why gross margins don't matter. Okay. So what really matters is, what is your overhead cost per hour and what is your net profit per hour? Those are the things that absolutely matter. So overhead cost per hour is for each billable hour, how much overhead you have to add to determine net profit. All right. So, think about, we're going to go through the P&L in a little bit, but the best way to do it is your total overhead divided by your number of billable hours. And before you say, well, I haven't been tracking our billable hours, start. You need to know, if you pay a guy for 40 hours a week, is he billing 40 hours a week? Yes or no? If he's not, how many hours is he actually billing? You need to know that. I mean, if he's billing 20 hours a week and you're paying him for 40, what's he doing for the other 20? Got to start tracking it. So if you want to get a sense of where it might be, we're about 6 months into the year. I would either do last year's year end, take your total overhead from last year divided by your billable hours, or wait until the end of June and do the same thing. You'll get your overhead costs per hour. The net profit per hour is for each billable hour, how much net profit actually drops to the bottom line. It's just a P&L. And you have to decide how much you actually want as net profit. It's funny, and I can't is not the right word. I will not tell you what net profit per hour you should have, because you own the businesses. All right. It's your name on the bottom line. You're responsible for payroll. You're responsible for everything. You have to determine how much net profit you want to earn for every billable hour. And I will tell you a funny story. So I was driving back to to the shop of a brand new client. And I always ask the question, well, how much net profit per hour do you want to earn? And I explain what it is. And he goes, well, I don't know. Well, I'm not, how much should it be? And I said, I'm not telling you what it should be. So he says, $20 an hour. And I said, if that's where you want to start, we'll start there. He goes, yeah, that's where I want to start. So we did. And then about 6 weeks or 2 months into it, I get an email. Is $100 net profit per hour too piggish? And I just started laughing. So I called him, and what happened? He goes, we had a job where Murphy went to sleep. Literally, everything came out absolutely perfect. And we actually earned $100 net profit per hour, and it was more than 100. And so I said, he was really happy about it. He was able to give a donation to his favorite charity, and et cetera, et cetera. So last week, this was about 6 years ago. And last week, he sent me an email that he had just job costed some jobs with the subject line, a lot better than our $20 net profit per hour years ago. And they were all over 100, every single one of them, somewhere into the 200. So he shares. I mean, all of his employees get bonus based on net profit per hour. In good years, they do really well. In not so good years, they don't do as well with bonuses, but they all are bottom line oriented, and they know what it takes not to make a customer mad, keep your customers, but keep them profitably. So you take your total net profit divided by your billable hours. That's it. It's not hard. All right, let's get into some profit and loss statement basics, okay? P&Ls. Profit just means revenues were greater than expenses. If you had a loss, your expenses were greater than revenue. It does not tell you how much cash you have in the bank. Profit does not equal cash. Profit is a P&L value. Cash is a balance sheet value, and we'll get into balance sheets a little bit later. The P&L is, it's good, bad, and indifferent, because your P&L start over every month. If you had a bad month, you can go, thankfully, this month is over. We're done. Let's do better next month. Or, thankfully, this year is over. Next year is going to be a better year. It starts and stops. That's it. It's either a month, a quarter, a year, da 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 da. And it literally starts over at zero. January 1, 2024 at 12:01 a.m., you had zero revenue and zero, it started over again. It was zero. Your P&L was zero. Now, it wasn't that way at the end, but February 1st, the month of February started over again. You will accumulate through the year, but every month starts over again. Here it is, revenue, and I'll explain sales in a minute, minus your cost of goods sold, which is also called direct costs. That gives you your gross profit. Subtract out your overhead and you get net operating profit. Subtract out other expenses or add other income, and that gives you your net profit before taxes. I have a tendency to stop at net operating profit because other income and expenses are not expenses or revenues that you get because of operations. They're because of assets, all right? Balance sheet items. So let's take, little difference. Here are the 6 categories: revenue, cost of goods sold, gross profit and gross margin, overhead, net operating profit, and net profit. So revenue and sales, there is a difference. Revenue is the work that you generated and billed for in an accounting period. Sales is the work you sold, but not necessarily billed in that accounting period. So for those of you who are COD, most of the residential work that you do is COD. You go to the customer's home, she pays, whether it's a replacement unit or whatever else it is, so that your revenue is pretty much going to equal your sales, right? Except in one case. When you do maintenance agreements and they pay up front, the sale is the maintenance, how much she paid, $200, whatever, $500, whatever she's paid or he's paid. The revenue comes when you actually do the maintenance work. All right. So it goes into a deferred income account, and we'll talk about that on balance sheet, because you have gotten money in the door for work you haven't performed yet, and you are liable to perform that work. That's what that means. So the sale is the maintenance agreement. The revenue is when you do the heating maintenance, or you do the cooling maintenance, or you do the plumbing maintenance, or you do the generator maintenance. That's when you then look at the revenue, because you have the expense against the revenue and you have a consistent gross profit. Okay. All right, so let's take a look at some of the sales categories, or the revenue categories, I'm sorry. Service, maintenance, replacement, new construction are the main ones for contractors. All right. Now, the question that comes up, you could do it, all right, residential HVAC, commercial HVAC, plumbing, electrical, you can do lawn care, you can do pest control. I mean, whatever you're doing, each area has to have its own revenue, its own cost of goods sold, own gross profit. And then you can departmentalize, and we'll talk about that in 1 second. If you have different trades, yes, you departmentalize. You don't go into QuickBooks and go sales, or don't go into QuickBooks and go income, which is even worse. What was it? Was it heating and air? Was it plumbing? Was it electrical? Was it something else? And then you departmentalize the revenue, the direct costs, and the overhead, so that you know that your heating and air conditioning department either made a profit or didn't. Your plumbing department either made a profit or didn't, and all the different departments that you can have. My rule about departmentalization is when your field personnel work strictly in one department most of the time. So you don't have a guy working 50% of the time in service and 15% of the time in install. You have dedicated commercial and residential techs. You have dedicated maintenance, service, replacement, new construction personnel. That's when you departmentalize. Otherwise, you're guessing at what the labor actually was. All right, cost of goods sold, which is the next piece on the P&L. It's also called direct cost. It's expense that you have because you generated revenue. Excuse me. Okay. So here's some example of cost of goods sold. Billable labor, obviously. Those of you who are union dues, materials and equipment, commissions. Commissions have to go in cost of goods sold. If you pay the salespeople a salary, that goes in overhead, because you pay that whether they sell something or not. You don't pay a commission, you don't pay a spiff unless something gets sold. So it's the cost of sale. Freight, subs, permits, travel to job sites out of town, anything that's an expense because you sold something. You might also have credit card fees and that kind of things in here, because most of the time now, credit card fees you don't get until you actually sell something. Not cost of goods sold, unbillable labor, training, vacations, things like that, material purchase for inventory and stock, and our salesperson salary. Now, here's the gray areas. Some contractors put payroll, taxes, and cost of goods sold as they apply to billable labor. Some do not. Some leave it in overhead. Some put truck expenses. I don't care where you put it, to be perfectly honest, because I care about net profit per hour. I could care less what your gross margin is. I could care less what your gross profit is, unless it's negative, of course. Then you have materials in there, usually equipment that are really inventory rather than cost of goods sold expense that month. Is usually the answer. And we talked about that last time when we talked about accurate bookkeeping. So these might be, all right? It depends upon how you want to do it. The most important thing is for every billable hour, how much drops the bottom line. That's the number that we want to have. All right, overhead is an expense incurred because you need to keep your doors open. All right, it's the cost of doing business. I generally divide it into two pieces. I divide it into payroll related overhead, i.e. compensation expenses, and non-payroll related overhead, which are G&A or general and administrative expenses. Okay. So payroll related expenses include everything. It includes health insurance. It includes other 401k type benefits, includes the payroll taxes that you pay on top of what is taken out of your employees' salaries, all overhead labor or overhead salaries, all owner salaries go in there. All right. So this way, because I like to know, and one of the ratios that we do is for every dollar in sales, how much is spent on payroll and payroll taxes. We need to know that number. It's really easy to pull it if it's right in there. Just add your direct labor and that number and you get it. Okay. All right. So here's some idea. Non-billable time, personnel, office personnel, all owners' time that's not billable to a job, and all benefits, workers' comp, 401ks, you know it. G&A, everything else, advertising, bank charges, professional fees, rent, vehicle expenses, everything that's on the bottom part of your P&L, basically. Those are your G&A expenses. Now, other income and other expenses, I generally, you're going to put it on your P&Ls, but it's cash that's generated outside of operational activities like interest. You're going to get a little bit of interest on your savings account these days. You might sell an asset and the asset on your books was, $1,000 and you sold it for $2,000. Well, guess what? You get to pay taxes on the extra $1,000. It's a gain on the sale of an asset. Other expenses could be, one-time legal fees, loss on a sale of an asset. So on your books, your truck was worth $1,000. You got paid $500 for it. So you get to take the $500 off your taxes in this case. All right. So here it is. P&L, revenue, minus cost of goods sold equals gross profit minus overhead equals net operating profit. And I stop there, but other income and expenses are usually on there and net profit before taxes. Okay. All right, let's talk a little bit about pricing basics, because all I do is I turn the P&L upside down. The revenue that you have to generate, your service pricing, for example, is your net profit per hour plus your overhead cost per hour plus direct cost. That's it. There's no guessing about what a gross margin needs to be or what an overhead factor needs to be or all that sort of fun stuff. Add numbers. Period. All right. So let's take an example. The highest tech earns $25 an hour. Their billable hours are 1,400 hours. This is really important. The overhead cost per hour is 40, and the net profit per hour is $75 an hour. All right. So what should the service rate for the company be? Good question. So all we're doing is taking the P&L upside down, the net profit of $75. We're adding our overhead of 40. So our gross profit's 115. Our labor cost is 25. So our selling price would be $140 if it was 100% billable. but it's not. There are only 1,400 billable hours, and this is what a lot of contractors forget. So we have to take the 140 and multiply it by the 2,080, which is 52 weeks times 40 hours a week, divided by your 1,400. So your maintenance clients actually have to pay $208 an hour to cover all those unbillable hours for this guy, right? And this is maintenance, all right? If you've got an 85, 15% discount, you take the 208 and divide by 0.85 or divide by 85%. And everybody, the demand service rate at that point is $245. So it's pretty easy to do pricing. All you're going to do is turn the P&L upside down. Once you know your overhead cost per hour, you know the net profit per hour you want to make, and you know your direct costs. How many hours is it? Pretty easy. It's addition and subtraction, which we can now do on our cell phones. All right, that's how easy pricing is. Don't make a mountain out of a pricing molehill. Not worth it. All right, let's look at some balance sheet basics. Balance sheet is like an elephant. And as a result, it's a snapshot of your business health at one instant in time. It changes every day because your cash position changes every day. You're either writing checks or sending money out, or you're getting money in, or both. And the snapshots are taken to coincide with the P&L date. So balance sheet as of January 31st, which is your P&L for the month of January, February 28th, except in leap years, P&L through February 28th, all the way through like that. And why is it like an elephant, right? It never forgets. It's more important than the P&L. But think about it. It started the day you started your business, and it will continue. Your balance sheet continues until you sell it, close it, decide I'm done, I don't want to do this anymore. Then your balance sheet goes away, right? So your balance sheet tells you is the wealth. Your P&L is just profit and loss, and that's it. That's it. All right. Balance sheet answers the questions. Is your profitability increasing? Now you're saying, well, my P&L tells me whether I'm profitable or not. Yes, for a moment in time. Think about it. It's for a month, a year, or maybe a week. If you do a P&L once a week, you can do that. There's nothing that says that you can't. But your balance sheet actually tells you whether the profitability of your company is increasing over a longer period of time. Can you pay your bills? Yes or no? Is it getting easier or harder to pay your bills? Are you headed for a collection problem, an inventory problem, or a debt problem? Those are the questions that your balance sheet actually answer. And this is the one that most contractors don't pay attention to. You look at your P&L, I made a profit or a loss, and you throw it in a drawer. Now, you got to do the analysis. You got to actually look at it, and you can do it in less than 10 minutes a month. I'll show you. All right, so balance sheet is called the balance sheet because assets have to balance liabilities plus net worth, or equity, or capital, or whatever you want to call it. Your assets are on your left, and your liabilities and net worth are on your right. They balance. Remember, one of the mistakes that we look at very, very closely is that a balance sheet doesn't balance means that the financial statements are wrong. It's easy to see. Assets, liabilities, and net worth, they should balance. So these are the types of categories on your balance sheet. We have current assets, long-term or fixed assets, current liabilities, long-term liabilities, net worth or equity or capital, or whatever you want to call it, okay? So let's take a look at them one at a time. Current assets are things that are either cash or assets turned into cash within a year. Generally, it's cash, obviously, accounts receivable, inventory, and prepaid expenses. You notice that I have those in blue, and then in gray, I have work in process and under billings. Unless you do a lot of commercial long-term projects, 6 months, a year, 2 years, whatever, you will not see work in process and you will not see under billings. So worry about the top 4, unless you're in a commercial in that environment. So you also have to watch out for your accounts receivable, because there are 4 types of accounts receivable. There's a trade account receivable, which is what your customers owe you, mainly from the commercial perspective, because remember, residentially, you're supposed to be collecting your money every time you do work. retainage for larger commercial jobs. And then employee receivables, which is generally tool accounts, or if you loan money to your employees and it gets taken out of their paychecks every week to pay it back. And you can have owners' receivables. You can take money out of the company's loan. I will tell you right now, the IRS frowns on that big time. They may say, no, it's salary, go pay the penalty. But I've seen it. Inventory. One of my favorite topics. All right. If you are smart, you'll put inventory on your balance sheet now. All right. I teach a class called Building Profit and Wealth, and we were talking through the inventory issues. And I had a guy sitting in class, and he goes, I don't have inventory on my balance sheet. I said, how much inventory do you think you have? About 200,000. This is his answer, not mine. I said, what are you going to do with the company? He says, I'm planning on selling it. So the normal multiples right now are somewhere between 4 and 6. So I said that to him. I said, so you're willing to take $800,000 to $1.2 million less for your company because you're not putting inventory, or refuse, or too lazy or stubborn to put inventory on your balance sheet. And his face went white. Because think about it, if you don't have inventory on your balance sheet, your profit and loss, you have $200,000 less every year in profit, because all of your material and equipment goes into cost of goods sold when it shouldn't, because you haven't used it yet. I mean, he literally went white. Not really. I mean, he was going to end up, if he didn't, change his ways, which he went back and did, from what I understand. That was $1.2 million less for your business because you're too stubborn to put inventory on your balance sheet. Give me a break. Put it on there. It's not that hard, especially if you're smaller. Get used to doing it when you're smaller, and when you're a 2, 3, 4, 5, 10, $20 million company, it's easy at that point. So inventory changes every time. It's, every time you use a part or get a part in or piece of equipment in or use it, it changes every day. Otherwise you're kidding. But if you want a kid, that's up to you. It's your business. It's like you have to determine what net profit per hour you want. I can't tell you. All right, the long-term assets or the fixed assets are what I call the stuff, the things that you see around your shop. It's the furniture, it's the vehicles, it's the major tools, it's the computers and servers, the furniture and fixtures, building renovations, everything you can see, and it generally doesn't turn into cash within a year. All right, that's the difference between current and long-term. Current liabilities, which is on the right-hand side on the top, is bills that have to be paid within a year. Remember, current assets are things that are cash or turned into cash within a year. Current liabilities are bills that have to be paid within a year. Do you think we divide current liabilities into current assets to get a ratio that we take a look at? Yeah, it's called current ratio. That needs to be increasing, which means that your profitability is increasing. So that's how you can tell whether your company is becoming more or less profitable. Okay. So here's a small list of current liability. Accounts payable, obviously, credit cards payable, payroll and business tax payable, your lines of credit if you have it, maintenance deferred income, customer deposits, warranty, current portion of long-term debt. Long-term liabilities, and we talked about this last week when we talked about bookkeeping, is to make sure that, when you're repaying a note, part of its principal and part of its interest. But that's not that we're long-term liabilities are notes and loans that are multi-years, all right? There could be loans that you're paying because you bought the company, through a note. I mean, any number of different things, vehicles, plasma cutters, whatever. Vehicle loans, mortgage loans, other business notes are your long-term liabilities. And then we get to what I call the fudge factor, which is net worth or equity. And why do I call it a fudge factor? If you decided, I have enough, I'm done, I want to sell everything off, theoretically, you turn all your assets into cash, pay off all your bills, and what would be left is what's on the equity section of your balance sheet. It never happens. Think about it this way. If you have $100,000 or $50,000 of inventory on your balance sheet, Are you going to get $50,000 of value when you sell it if somebody's buying it? No. I mean, that right there shows you that it will never be that accurate. And that's why these days that most companies are bought based on P&L valuations, not balance sheet valuations. All right, that's why, because the net worth is such a fudge factor. So it's generally the initial business value investment stock or the value of cash or partner's equity or whatever else it is, plus retained earnings. And depending upon the type of business that you're in, a C Corp, you can't do this, but the type of business that you're in, you might have owner withdrawals or, shareholders withdrawals or whatever here too. It just depends upon the type of business that you're in. But these are the two major pieces of net worth. I do not use this very often. All right. It's just there. Bankers love it, but it doesn't have anything to do, for all intents and purposes, with the day-to-day building of wealth in your company. The day-to-day building of wealth is pretty much off the balance sheet, more so than on the balance sheet, because it has to do with the number of maintenance plans that you have. The more maintenance you have, the more valuable your company is, the wealthier your company is. And the only way you see maintenance is through deferred income for maintenance. And that's supposed to, stay at a certain amount, and every year somebody adds to it. When the work gets done, it gets taken out, et cetera, et cetera, et cetera. Okay. All right, so that's the balance sheet. Now, I said I'd tell you what you need to do every month. There's a P&L review that you do, and there's a balance sheet that you do. One of the things before we get into this that I'm going to beg you to do is every day, just like brushing your teeth, you log onto your bank accounts and you look at them, right? It's not only, somebody internal to your company who can be stealing from you. There are so many bad guys out there in other countries who know the routing number of your bank. They know how many digits are in the deposits, and they keep doing the random number generators until they get a hit. So I always ask that owners do this. So one of the clients said, okay, Andrew, who was his bookkeeper, I want you to go do this every day. And he did it, obviously. And so one day he saw two little deposits, like when you're setting up a new account, like 22 cents and 67 cents or whatever they are. And he saw them one day and he said, owner's just setting up a new account on something, and he just forgot to tell me, we've been so busy. Now, next day the bank calls. Did you authorize two $25,000 withdrawals from your bank? No. Those two little deposit thingies were the bad guys finding out whether this bank account was real. If you look every day, you would have he spotted it right away. He just didn't think anything about it, never even think to ask. He made an assumption. What he should have done was asked. So you'll see all the stuff. You'll see the good, the bad, the ugly. You'll see bounce checks. You'll see any ACH withdrawals, which is becoming another very interesting way of theft, is through ACH withdrawals. And they're harder to get back. All right, so please, every day, like brushing your teeth, just look at your bank accounts every day online. It will take you no more than 5 minutes. Have the peace of mind that, yep, what's in there is supposed to be in there type thing. All right, so every month you're going to do a P&L review. If you just look at your P&L statement from QuickBooks or Sage or Xero or, whatever else it is, you're not going to remember what you did last month. You're not going to remember what you did 2 months ago. You're just going to go, okay, I made a profit. Or what did I do a year ago? I mean, you don't, most humans, including myself, are not good enough to remember exactly what we did a year ago without looking it up. So what we do is we do this. The top left is monthly P&Ls. So what we do is we graph. The top line is total sales. The red line is total gross profit. The green line is overhead. And the purple line is net operating profit. And it looks like a EKG or an EEG or something like that, you can't tell squat about what's going on with your company just by looking at that graph. So if you look at the graph that's on the bottom, that is what's called trailing data, where we take a year's worth of data a month at a time. So for example, the data point for December of 06 is January through February, March, April, May, all the way through December of 06 revenues, add them together, divide by 12. February 07 is, no, January 07 is February 06 through January 07, add them together, divide by 12. So we get a trailing trend. Seasonality is taken out, 5-week payrolls are taken out. We can actually see the trends for the business. So in this case, you can see that the business revenue-wise is doing really, really well. The gross profit line is not going up as fast as the revenue line is, which means that they're doing more work at lower gross margins. That's what that means. The overhead line grew for a little bit. Now it's pretty stable. And the net profit line, which is the purple line, has gone up and has been staying pretty stable at the same time. So this way we can tell really what's going on from a P&L perspective of the business. Here's another one. Not too cool. We're looking at our overhead line, which is the green line, is now higher than the gross profit line, which is the red line. And you can see the trailing is going down. Not cool. You got to turn it around. And the only way to turn it around is profitable business and profitable pricing. That's it. It's the only way to do it. All right, let's look at some balance sheet ones. Again, liquidity ratios. These are the ratios that say, can you pay your bills or not? These are the ratios that say, are you becoming more or less profitable? Current ratio is the current assets divided by your current liabilities. And your asset test is, can you pay your bills if inventory isn't taken into the equation? And in this particular case, if you have no inventory, your current ratio and your asset test are identical. Receivables to payables is dependent upon whether you're COD, not COD, and whether you have accounts payable plus credit cards. Most QuickBooks do, so you have to add those two together because they're both payables. And from there, so can't tell a whole lot on the monthly graphs. Again, it's too up and down craziness, but we can tell from the trailing numbers that they've gone up. Now you're going to ask why the green line went down so much. All right. We stopped adding cash to receivables. They started a commercial segment of their business that started doing really, really, really well. And so we took the receivable, and if you're mainly COD, more than 50% of your business is COD, then you do receivables plus cash divided by payables. And when the revenues, or when the receivables became, and the commercial became more than 50% of the business, we stopped doing cash, and you're going to see an immediate go down, which you should. All right, so here's some graphs that are the debt ratios. Are you taking on too much debt? This is debt to equity, which is the blue line, and the long-term debt to equity, which is the red line. You can tell what happened. Look, 0, 0, 0, 0. And if you look at the dates, it's COVID dates. So that was the PPP loans. That's what COVID did. It's really kind of interesting. But it's an explanation, and it went back down. And then this is the productivity one for every dollar that you take in the door, how much you're spending on payroll and payroll taxes. Again, monthly looks like a sine wave. And trailing is actually trailing, and we're now down around 30%, which is about, for most companies in most states, where you want it. In states with really high payroll taxes, California, Oregon, Washington, Illinois, Massachusetts, New York, New Jersey, if you hit 40, 35 or 40, I'm a happy camper. It's really hard to get them down. And then we look at receivable days and inventory days. AR, on average, from the time you send out a bill to the time you get paid, how many days is it? Inventory days, on average, from the time you buy a part to the time you use a part. How many days is that? And we can see that receivable days, they did have a collection problem and it went away. And we have the same thing with inventory. It's staying around 20 days now, which is fine. But that's what you do to figure out where your company's going. And you can do it with software. And here's another way of looking at the trailing usage ratios. It's a little bit easier to see on that rather than two of them stuck together. All right, do you have any questions? I know I went through that pretty quickly, but I wanted to save about 10 minutes for questions if you have questions.
Everyone's shy.
Oh, I'll get some from email like I did last night. All right, so here's some options. There's lots of courses that I've done to teach you about how to price and how to do all this stuff. It's on HVAC Channel TV. So just go there and click on products and you're going to see them all. If you want us to look at your financial statements, we are happy to do it. Just send the email to Chris Beckham, C. Beckham at Financially Fit Business. We have a little format that we do, like last year's year-end P&L and balance sheet on an accrual basis, not a cash basis. Remember from last week, we have to do our business on an accrual basis, operationally anyway, not necessarily tax-wise. I'm happy to do it. We'll go through it with you and that type of thing. Or if you want to do those graphs and those, things that I showed you, you can subscribe to financiallyfit.business. That will also give you all the graphs and everything else like that. And the AI will also tell you whether your financial statements are accurate or not. AI is pretty good. All
Ruth, it
right.
looks like we actually have a question in the chat.
Okay, let's see. Do you have good times on when to buy tools for the company? Well, all of your tools, number one, you're going to have employees who are field employees have a set of tools that they keep. Every time you get a new employee, if you may need tools for that employee that the company keeps. So usually new tools are bought when you add field personnel. You should also have some sort of an agreement with your employees that says this is a company-owned tool, you're using it on the jobs. We will replace worn out tools and they have to bring the tools back. If you damage it, lose it, break it, you're responsible for replacing the tool. All right. So, as they get worn out, listen to me, as they wear out, yes, you will replace them. But if they lose them, leave them on a job. I mean, how many times have they left ladders on jobs? Give me a break. Lots of times that they've left ladders on jobs. Or, so-and-so has my ladder, right? Or so-and-so has my recovery machine, or so-and-so has this, or whatever else it is. The other thing that I find is really, really, really good, if you have an area in your warehouse and you're going to lock it up and you're going to put tools in that area, and you're going to sign out the tool on such and such a date, tool description, sign it out to whomever it is, such and such a date, and then there's a space for when they bring it back. You'll never have to worry about who has that tool. And they can't go like this. Somebody else has it. If they sign that tool out, they are responsible for it. Save you a lot of money in the long term and a lot of he had it type things. Okay. All right. Yeah. And last time I talked about the bookkeeping manual. If you want it, it's also on HVAC Channel TV, but that's the QR code for the bookkeeping manual. Now, like last week, a lot of you didn't want to ask questions here, so you just asked me questions individually, which is fine. And for those of you who did, I answered them. That's my phone number. That's my email address, and that's the website. Our King at Financially Fit Business, www.financiallyfit.business. Anything else in the chat? I don't see anything else in the chat. Do you?
I think we are all clear. It looks like we're okay to dismiss class a little early today.
Yeah, 9 minutes early. That's because nobody had questions.
All
Thank you
right.
all for joining me tonight. It's not hard to do a P&L and balance sheet. It's just like reading a wiring diagram.
All
Invest a few minutes a day. You'll get it in like no time and think, why did I ever think that was hard? Have a great rest of your day. Thanks for joining me.
right. Bye, everybody. Thanks again for joining us today, Ruth. Hope you have a good
My
one as well.
pleasure. All right. Have a good
All right.
one.
Bye-bye.